Welcome back to the best prop for you trading floor. Today we are breaking down silver, ZAG, USD, CFD. On Tuesday, we saw silver fall around 3% from its weekly open, I would say, breaking below the critical 70 psychological support. The driver, of course, is geopolitical escalation. President Trump has issued a deadline for Iran to meet US demands by 8 p.m. Eastern time tonight. Which is after midnight in Cyprus or BST. Actually, I would say 1 BST. While Tehran reports ongoing infrastructure attacks and warns of strikes beyond the region if the US oversteps. Because of this, of course, and paired with a surge in US dollar and fading expectation of Fed rate cuts, silver remains suppressed and trades around. Actually, we're not going to find out with these two, but with these two, around 40% from its record, from its peak in January 2026, just earlier in the year. The macro bias is undeniable to the downside, since also the technicals have us below the 1 hour, the daily Fibonacci Bollinger Band resistance, which sits at around the 78 level. And we're going to draw that level here to ensure that when we do our multi time frame analysis, we know where to look to have a visual representation of the higher time frame. And well, they are definitely the current price action definitely shows an intraday trap, if you ask me, actually. So the daily does show the bearish bias below the median Bollinger Band around the 77 level. So, and just how much the downside has dominated over the past, February, nearly a month now, at least from the moment that the median line was broken. But the reality on the ground is that we are entering a tightening consolidation phase, which I think is a bit obvious to see on the daily here. So for that, though, we're going to go on the 4-hour chart to confirm that thesis. And we do see some sort of upward biased consolidation, I would say. Some could consider this as a flag. So we could be looking at a potential de-risk further lower down, or if we really do look at the 4-hour closer, we do see a consolidation in this specific territory below the median band, and notably we do see a double bottom pattern. Now, if this is a double bottom indeed, and we have a rejection at the bottom Bollinger Band at the same time, the interesting thing is that the break of the neckline, okay, would probably open the door all the way to 75.80 as well as the 77. Okay, and why? Because double bottoms or double tops, they actually typically extend the same distance, the range, right, of the width of the pattern itself. So if that's the neckline, and we use the breakout point, and we go up to the 77. Okay, so there is some sort of potential for us to go back to the 77 level. Now, this rejection down here on the 4-hour chart, okay, because it's important, provides an opportunity for a mean reversion trade. The initial target, I think, would be the 4-hour candle, the 4-hour median line. Then we've got the 4-hour candle at 75, because this is the second confirmation candle, and a opening, the opening of this potential 4-hour price action is quite important, because it carried a lot of momentum to the downside. So if we take it out, we'll be taking out a liquidity sweep. So we can look all the way up to 77 if these two, I would say also the third one would be the upper Bollinger Band barriers are taken out by bulls. Of course, To find out exactly an entry, we would be looking to not just pulling our Fibonacci from top to bottom, but also going down on the 1 hour chart to see where we really stand. Critically, we've highlighted the 73 level. We highlight here the 73 level, which is the 1 hour Bollinger Band of the to the top side, which actually coincides with the 61.8 Fibonacci retracement. Okay, and this is one of the levels that we really need to pay attention to. Now, to find our entry, we really need to, look at when we're going to re-enter the Bollinger Band, the range of the Bollinger Band, as well as closing above 71.20. Why? Because this is a 1 hour candle, okay, that led to this rejection, to this move initially and rejection. This is considered a recoil, guys. Okay, recoils typically transpire into continuations, but not if we manage to reclaim the opening of that 1 hour candle. Okay, so this is very important that we close above 71.20. After 3 cascading bearish candles, okay, this is a recoiling that coincides again with a RSI oversold, near oversold move. So the idea now is to go all the way up to at least the 50 RSI, which could potentially bring us all the way up, not just to 38.2 at 72, but perhaps the median line. And reclaiming the median line would mean that probably we go to the 50 and then 61.8. Only a breakout above here would let us go up to 76.20 and then 77. I don't think that's going to happen overnight. But the important thing is that because we do have plenty hours until the deadline expires, and then the subsequent military action, if we see any, if we actually don't see any, that will help boost prices up to 77. But if that will be the taco trade, but if we don't, then likely as high as we go until then, we might revisit that low and perhaps even break lower. So we need the confirmation, right? And without the early candle close above, in the one case, the 71.30, or in the other case, below the 69.50, excuse me, it is unlikely that we are going to have much more clarity. So we trade this at best for you in a specific way. It looks like a high probability opportunity to go long at the 1 hour chart. There is a real possibility that this becomes a taco trade, meaning, Trump chicken sound. The deadline passes without severe military action, and the market aggressively buys the dip on the relief rally. But remember, we cannot predict war, or even worse, Trump. Keep your stop losses extremely tight right below the 70 level, the 69.51. And if geopolitics escalate, you will want to get out immediately. Manage your risk, protect your funded account, and I'll see you in the next breakdown.